Hello and welcome to the Currency Exchange, NatWest Markets FX podcast, where we break down the major themes and events driving currency markets this week and the weeks ahead. I have a fact to start today's podcast with, and that fact is that since 2015, no British Prime Minister has served their full term in power. And it's within this context that the current PM, Keir Starmer's term, looks a little bit in doubt. Paul, I have to draw you in on this. How should we start thinking about UK politics at this juncture?
Yeah, well, it's definitely been the primary focus for the bond market and the currency this week. Not to say that it's had a massive impact. Actually, both have been relatively well behaved. I mean, there is that saying, isn't there, sort of a week's a long time in politics, and so it certainly proved. Last week we were talking about the prospects of the regional elections and whether that would cause pressure on the leadership, and it feels like things have gradually moved through the week. Politics always very murky. You never know what's going on in the background, and there's also lots of moving parts to what looks like ultimately will be a leadership challenge. At the time of recording, we've just seen on the news headlines that the health minister, Wes Streeting, has just resigned. That doesn't formally start any kind of leadership contest. The reason I said that it's a little bit murky and lots of moving parts is that one of the candidates or expected candidates for the leadership is Andy Berman. He's not actually a member of Parliament at the moment, but you need to do that, or in the Lords, but it's much more unlikely. I think markets are a little bit complacent over politics. I think they see a two-horse race between the current Prime Minister and the health minister. Because one of the other candidates, Andy Berman, would still need to have a by-election. In his statement when he resigned, Wes Streeting, he did mention about having a broad leadership contest or a debate, and that might play to the idea that ultimately there'll be time for a by-election, Andy Berman to come to the Houses of Parliament and then an election. So where does this leave us? Well, it could take, say, six weeks for a by-election, and then you would have a leadership contest after that, if that's actually where we're going. Obviously, things are uncertain at the moment, and then that's for the NEC of the Labour Party, the National Executive Committee, to decide what that leadership looks like. For markets at a very high level, and that's all I'm interested in, about how markets see these political events rather than some kind of personal view. We do think it would play out through bond market volatility if through the debate of any leadership contest that the members or individual candidates will be talking to the people who will be voting rather than to financial markets, and therefore they might be slightly more sort of fiscally loose and things like that. But with the marginal buyer of gilts, overseas investors, is clearly something to focus on over coming months for the currency and the bond market.
Yeah, how does that kind of bond market impact trickle through to sterling, which has been kind of remarkably resilient lately?
Yeah, as you say, remarkably resilient. I sort of just was doing a PowerPoint slide before coming in to record this week's podcast, and I have it titled "The Curious Case of Sterling Resilience." And I think there's a number of reasons why the currency is held up better than I think a lot of people expected. There is that little bit of complacency in the market about maybe it's a two-horse race, and we ultimately think it would be more than that, and therefore that complacency could crack. Major currency markets in general look like they're just headline fatigued. There's lots of headlines both in the UK and outside of the UK, in Asia and the Middle East, and it feels like currency markets are just becalmed generally. The performance of the bond market yes, gilts have underperformed, but not in a particularly volatile way. It's not like UK fixed income markets are selling off when everyone else is rallying. So I think if we got more volatility, that would play negative. And also, I think, as we've spoken about over the last couple of weeks, I think it is about maybe relative safe haven flows from the Middle East into the UK, temporarily providing some support, and also maybe there's some hedging and maybe short-term interest rate support for the currency. So for the time being, at least, sterling holds up. I think once we get into sort of late autumn into a budget, if we do get change in policy and leaders, I think that might be when the currency comes under a little bit more pressure.
Okay, something to keep an eye on. But, on to wider politics, I guess we had the long-awaited Xi-Trump summit finally took place this week. But, on his way over to the summit, U.S. Treasury Secretary Bessent actually made a pit stop in Japan. So, Brian, I have to bring you in here. What did you make of, Bessent's visit to Japan, and what impact did it have on the Japanese yen?
Yeah, thanks very much, Eimear. So, obviously, this meeting was in particular focus because of recent activity from the MOF and BOJ, specifically currency intervention that, the breach of 160 on the top side in dollar yen in late April, and then it looks like again in early May. The MOF and Bank of Japan appear to have intervened in FX markets to specifically strengthen the yen, sell the US dollar, buy the Japanese yen. And so this intervention was particularly notable in the timing because of this meeting, because, we've known in the past there's been discussions between the US side and the Japan side about the conditions under which intervention could be merited. And, there's other issues to consider as well, which is that, the U.S. is generally is trying to push for open and fair markets. They push against manipulation of currencies. They have a semi-annual report where they specifically call out foreign economies for manipulation of markets in their favor. Normally, when we're thinking about the U.S. being against currency manipulation, we're thinking about the U.S. not wanting your economy to artificially weaken your currency to make your exports more competitive. Not as much in this other direction, where in this case, the Japanese officials are trying to strengthen their currency. But I think this was still an important moment because this is the first confirmed interventions that we've had from the MOF BOJ since the change in leadership. We now have a new prime minister. We have new leadership in the finance ministry. And we also have new leadership in the U.S. This is the first confirmed intervention since President Trump and his regime took over. And so this was an opportunity for the market to see if Treasury Secretary Bessent would give a green light for interventions, maybe put a yellow light out there to say, okay, maybe hold your horses a bit, or an active red light and say something to the effect of, this is not something that we would condone happening from here. And I would say that it was a yellow light maybe favoring more in the positive direction in terms of the final readout. And so, Bessent's readout of that meeting was that he lauded Japanese officials for their level of communication and coordination in addressing undesirable excess volatility in currency markets. And so I think the signal there was that Bessent was lauding the Japanese officials for their communication. I think the clear signal there is that they pre-informed the U.S. government of their intention to step in the currency. But at the same time, I don't think this was a moment where Bessent gave the full thumbs up for them to shift into a much more activist intervention stance. You notice that the statement there references excess volatility in currency markets rather than necessarily trying to defend a particular level. I think that's still an important point of emphasis, for the U.S. administration, generally speaking. And, as all of this is happening, we know just a few months ago in January, the New York Fed, on behalf of Treasury, on behalf of Scott Bessent's Treasury, performed a rate check in dollar yen where they asked the market if there was a level at which they could sell, something that created massive waves in the market at the time and had the market questioning whether or not the U.S. was maybe softly shifting away from its strong dollar policy. Now, Treasury has pushed back against that, in various statements since. I don't think this statement necessarily changes that at writ large, but I think this was a moment for the market maybe to see if the U.S. is trying to give the a full green light for Japan to continue intervening, or a big red light to tell them to effectively stop intervening. I think this was somewhere in the middle, maybe not unexpected, but I think it was somewhere in the middle. Still an important sort of milestone benchmark for the possibility of future interventions.
Yeah, very important distinction, that they supported the communication around it, but not necessarily the actual action. Besant actually called Japan's fundamentals strong during his meetings. Do you think this applies to the currency as well?
I think for the equity market, if you look at the equity market, the performance there has been quite resilient. Maybe not as much for the currency. And, we continue to see fundamental challenges, for the currency. And I think that's in part by design, right? You have an economy that is running fiscal policy that is quite loose and is looking to pursue additional fiscal stimulus with additional measures such as a temporary cut to the consumption tax expected to be rolled out this summer. In combination, you have monetary policy, which is still quite loose, both in relative terms and in absolute terms. You have negative real interest rates. You have interest rates that are accommodative relative to the Bank of Japan's own estimates of neutral. And the Bank of Japan continues to slow play their tightening cycle. That, it's understandable why they've delayed tightening in response to developments in the Middle East and the real growth risks that come from lack of energy supplies coming from the Strait of Hormuz. It's understandable why they've taken that decision, but at the same time, it comes as the markets have repriced very hawkishly in pretty much every other jurisdiction as well. So, for example, there's a possibility that we get an ECB rate hike coming up here. The Federal Reserve is now seen effectively on hold now, and Bank of England could be hiking at some point as well. Just think about a couple of different economies, and others have actually already taken action. The RBA in Australia, for example, has already hiked. And so, from just a front-end relative rates perspective, the Bank of Japan delaying its tightening here, expected tightening, is something that I think is a negative driver and something that remains a challenge for the currency. So interventions, I don't think change those fundamental drivers. I think, the way that the economy is postured at the moment is one where very loose fiscal policy combined with still loose monetary policy, that combination tends to be a drag on your currency. Intervention can't change that. Intervention can't narrow those interest rate differentials. What it can do is it can remove that excess volatility. It can influence short-term positioning, and I think that's primarily the goal here. What I think we'll be watching from here is whether or not Japan is shifting into a more activist posture, or whether or not this is another example of a couple of isolated incidents of intervention with a period of a longer pause. So just as context, we've had a couple of instances of confirmed intervention since 2022, and sort of call it the post-pandemic period. In each of those cases, we have confirmed sessions of intervention, 2 sessions of intervention followed by a period of pause, a max of 2 in each of those. At the moment, it appears, if you look at the data, we're not 100% sure, but if it appears, if you look at the data, that we have had at least 2 sessions and maybe more. I think that's probably the big factor that we'll be watching here is, again, with new leadership, are they moving into something more activist, or is this just we're going to do an intervention to try and reset positioning that doesn't necessarily fix those fundamental challenges facing the yen? So I do want to turn over to you, Eimear. I think this might be the longest we've gone in this podcast without mentioning President Trump and Iran. But I think this is an important opportunity to discuss, maybe the biggest non-Iran milestone within the context of this war, which is the Trump-Xi summit in Beijing. Because I think the markets have loosely seen this summit as a very important moment in the crisis. I think now with hindsight, it's clear we have not gotten that resolution that I think the market was hoping for. But I did want to ask you, Iran wasn't the only thing on the menu. Obviously, these two economies, there is a ton to discuss between these two leaders. So let me just start. What do you what's been agreed in the Trump-Xi summit, and how are you thinking about that as it relates to currencies?
Yeah, I should say that we are recording on Thursday, so summit is still ongoing. I think as we record, Trump is at a very high-level banquet in Beijing. But, from the kind of headlines and the readouts of the bilateral meeting we have so far, it does look like 2 things have been agreed. So I think the first is market access for U.S. firms in China. So this was actually both, announced by Xi in very early comments saying that China would, increasingly open the door to U.S. firms. And it also appeared in the U.S. readout of that meeting. The second hasn't been confirmed, but it has been reported by Reuters. And that's that, the U.S. will basically approve sales of NVIDIA chips to China. So rather than this being really a win for either side, China does need access to high edge or cutting edge US semiconductor chips, but it's really kind of, I guess, a recognition both from the US and from China that there has to be some degree of interdependence between the two countries' economies. And that, they should kind of pivot away from the isolationism that has kind of defined, I guess, their kind of relations over the last few years. So that is what we've had so far at this juncture.
So if that's what we've gotten so far, what remains unresolved here?
Yeah, I think kind of most telling sometimes can be what isn't mentioned. And I would say the two big things are Iran and also Taiwan. So it was interesting that, in the US readout of that bilateral meeting, Trump mentioned a number of times that, they had agreed that the Strait of Hormuz had to be opened, that Iran should not have a nuclear deal. But China in its readout barely mentioned Iran. It just barely came up. I think there was a reference to the Middle East. And I would say the same on Taiwan. Comments from Xi very much saying, warning, I guess, US in very kind of explicit terms, which are uncharacteristic for Xi, that, this is the big issue. The Taiwan issue is the biggest issue, and it could force them to actually come in to conflict. However, in the US readout of that meeting, Taiwan was not mentioned. I think sometimes what is not said is really the biggest elephants in the room. So I guess the risk at this juncture is that you have some kind of quid pro quo, which could, come in the shape of, for example, the US basically halting weapon sales to Taiwan, in exchange for some kind of support in forcing an agreement with Iran.
Yeah, I think that's super interesting context. I mean, like you said, sometimes it's what goes unsaid that the market should really be latching onto rather than necessarily what is said. I mean, this is not the first time we've had discussions around economic policy, China potentially opening up to the US. We've had Trump 1.0 trade war, Trump 1.0 trade deal, Trump 2.0 trade war. We still have the possibility of, changes in tariffs coming in the U.S. as well on a number of economies, thanks to the APA decision. China's sort of in that basket. So really interesting timing for all of this, given the economic relationships, but also the geopolitics ones that are, not necessarily sitting beneath the surface, but, certainly interlinked to those economic ones. Let me ask you as well, just to end on the market implications of all of this and the currency impact. How are you thinking about currencies as we think about what we've heard and not yet heard from the Trump-Xi summit?
I guess to put this in context, coming into these meetings, we've seen, incredible strength from the yuan or the Chinese yuan currency. And even if you're looking kind of week to date trade against a broadly stronger dollar, the Chinese yuan has been incredibly resilient, even managing to make gains against it. Kind of on a more longer term, actually dollar CNH made a fresh new 3-year low on Thursday. So you are talking about, real resilience of the currency. Not to be, I guess, too cynical, but the currency and how it's traded has been a key, I guess, complaint of U.S. authorities going into previous rounds of trade negotiations with the Chinese side. So it is probably a little bit pragmatic of Chinese authorities wanting to put the yuan on a stronger footing going into this summit. So we do think there is a risk that authorities could really push back against a stronger yuan fixing and actually allow for a little bit more weakness in the weeks ahead. That is probably all we have time for this week. I just want to thank Paul and Brian for joining me again on the Currency Exchange. If you did like the podcast, please do click like and subscribe so you can get the latest episode first. Thanks again.